As of yesterday, the market hit the highest valuation that we've had, and this is on a forward earnings basis. The market hit this highest valuation level we've seen since the turn of the century. Only in 1999 were valuations higher than they are now, and they got a little bit higher, but not dramatically so. So again, valuations obviously very elevated, and that's all subject to expectations from investors that earnings are going to catch up with the markets in the future. So we'll see what happens. But just the reality is that earnings expectations are well ahead of probably what reality is going to turn out to be, but that's always the case. In the middle of kind of a market advance where investors are just chasing any asset price higher, that typically leads to bigger reversions, because the only reason for that is that at some point the reality of what is going to come out in terms of earnings growth tends to be a far different thing than what the expectations were.
This is the S&P forward PE ratio. Forward PE is currently at 22 times 8. The 30-year average is 17. The KPE is currently at 39.8. 28.4 is the long-term average on that for this century. Now, again, when you look back historically, previous peaks, pre-turn of the century, were at 23 times earnings. Because of all these monetary interventions, because of zero interest rates, all these other policies, we've raised the average PE ratio. So again, when you take a look back, and it depends over what period you're looking at, but since 1980, as an example, the average PE went from about 9 to about 15, 16, 17. And so depending on your time frame, so before you start to look, this kind of running bull market that we've had, from 1980, you had kind of the flat period between 2000 and 2013. And then you've had this largest bull market in U.S. history now that started between 2009 and now. That's raised the average PE ratio on this long-term look. So when we talk about valuations being at 40 times earnings, you have to also understand that the median and the average PE has also been lifted because of all this monetary intervention. Dividend yields are at 1.5%. The long-term average is at 2%. So again, when you talk about equity risk premium, you're simply just not getting paid to own stocks right now. But again, we own them because they're going up. Our earning yield spreads, which is interesting, is negative 0.6 versus 30-year average of positive 0.7. So again, just from a valuation fundamental basis, there's very little value in the market. So you're strictly buying assets right now based on the idea that asset prices will continue to rally into the future. So just kind of something to keep in mind, just to kind of temper expectations. But we're seeing this across all asset classes. We're seeing this in Bitcoin, we're seeing it in metals, we're seeing it in emerging markets, we're seeing it in international markets, small cap and mid cap. It pretty much doesn't matter what asset class you're buying right now, you're getting a rally in that asset class, which is also risky when all asset prices start to correlate. When we start to move all asset markets to one, that becomes a much more risky environment for the market.
Catch me daily on The Real Investment Show. The link is in the description.